everyone, a few months ago I did an in-depth fundamental analysis on Aavas Financiers when it was trading at levels of around 1350, and from those levels the share price actually jumped to levels of around 1800. However, in last couple of months there's a healthy 20% correction in the share price. So in this video I would help you understand two major reasons for fall in share price, and I would also share my thought process on the same. So if you look at the quarterly performance of the company, its asset under management has grown by 22.1%, which is a decent growth. But if you look at the disbursement, it's only grown by 3.9%, and that too it is H1 to H1 comparison between FY23 and FY24. And if you look at the PAT, its profit after tax has grown by 17.9%. So as compared to the asset under management, their PAT growth is on lower side, which is again for H1 of FY23 to H1 of FY24. On quarter-on-quarter basis, the PAT has grown by around 13-14%. So all in all, there has been a slowdown in both the revenue growth and the PAT growth for the company as compared to the historical performance. And that is one of the key reasons why there is a correction. The question here is what resulted in slowdown in the disbursement as well as the profit growth for the company. So this slide would help you understand what is happening in terms of the margins for the company. So here you can see quarter on quarter basis there is a spread. And spread is nothing but your interest margin. Okay, so interest margin for the company has reduced from highs of 5.86% in September 22 to consistently at lower levels, and now it is 5.29%. Okay, and if you look at the cost of borrowing, it has actually increased. So earlier cost of borrowing was around 6.86% and has consistently increased. Basically, the cost of borrowing is the rate at which the company borrow money, and yield is nothing but the rate at which it gives loan. So yield for the company is constant, but the cost of borrowing has increased, and due to that their spread, which is their margin, has reduced. So there is certainly a pressure on the margins for the bank, and that has impacted the profitability. The question is what went wrong, why there's a pressure. So we'll come to that. In fact, the same question was asked in the con call itself, why the margins have reduced. The question is it because of increase in competition intensity, which we are witnessing, because on the one end, cost of borrowing is increasing and we are witnessing the yield decline. And what could be the trend going forward on the margin, right? So basically the person want to know what will be your margin outlook. On that, management has said that we have been saying we are able to maintain the spread at 5% and above. So it is currently above around 5.29%. Our endeavor is there, okay? But what we are trying to do is that the good customers are there. We don't want to let them go. So here management has clarified the reason why their margins have slightly reduced. One reason is that they don't want to let their good customers go. They want to retain their customer. And another reason is there is a pricing pressure on the new acquisition. So I hope you got a good idea. The reason why their margins have fallen is because A, they want to retain their good customer, and B, they want to do new acquisition, and because of competition they had to reduce their yield. And overall on the guidance, management has guided for around 5% kind of range, and they are currently above 5%. So this is the guidance on the margins. Apart from that, there was another question on the disbursement. Since the disbursement for the company are on lower side, they said that if you look at your listed peers and unlisted peers, they have half of the balance sheet of Aavas, and they are doing 78 to 85% of quarterly disbursement. And so what is the reason why the disbursement are on lower side? So there are two major reasons. One is the transition on the management side, and there is a transition on the tech side. So let me help you understand. So basically what has happened is there is a new leadership in place for Aavas, and Mr. Sachinder Bhinder has joined as MD and CEO. He was with Aavas, he was the CEO of MSME business since 2019, and now he has been elevated to the position of MD and CEO. So one of the reason is because of change in leadership, and another reason is because of the change in their tech stack. Basically, since the company is growing, it is also transforming its tech stack with projects Gati and Unnati, and their partners in journey include Deloitte, Oracle, Salesforce, and the objective is basically to transform loan origination and customer service to achieve 10x scale and minimize the TAT for loan application processing. TAT is your turnaround time. So they want to reduce that and basically want to automate the process and everything. And because of these two reasons, the tech transition and management transition, they are facing the challenges. But what management is saying that give us a couple of quarter and you will see that back in action. So this is a positive commentary on management side. And basically, I just want to quickly summarize. The reason for fall in yield is simply because there's an increase in cost of borrowing, and second, there's some competing pressure that has resulted in slight fall in interest rate to retain customer. And second reason is there's a slowdown in disbursement. And what is the reason for that? There is a management transition and there's a technology transition. So all in all, I think that this is a temporary phenomena. I think fundamentally Aavas is still looking very solid, and the long-term prospects are still intact. If you look at the management of the company, they are all experienced people. So spend some time, try to understand the leadership. They are all experienced guys. And if you look at the long-term plan for the Aavas 3.0, so if you look at it, it was Aavas 1.0, then 2.0 between 16 to 23. And from 23, it's the beginning of Aavas 3.0. And look at the kind of journey from 0 AUM to 1.8 billion rupee in FY13 to almost 26.9 billion, and then to 141.7 billion rupee by FY23. So the growth has been fantastic year on year in last 10 years, and number of branches have grown from 25 to 35 and all the way to 346. And if you look at the evolution, earlier it was a proof of concept of affordable housing, then perfecting the model of building the foundation of scale, and now the company is into scaling and institutionalization. And you can also see number of CXOs have increased from 1 to 4 and now 10 plus, right? And now this slide gives you a very good picture in terms of size of opportunity. If you look at the market size for Indian housing, it's 29.8 trillion rupee. And if you look at the year-on-year growth, it's around 14 to 15%. Within that, the market share is with 68% is with scheduled commercial bank, the big banks, and your housing finance companies have 32% stake. Within that, affordable housing finance companies are growing at 21%. Look at the housing market trend from 13.4 to 15, 18, 20. The market size has grown big time. And the interesting part is the mortgage penetration, which is just around 11.5%. So all in all, the growth driver are still intact. The opportunity size is big. Aavas is one of the strong player in affordable housing finance, has got a strong leadership, and historically the company has done fantastic. Look at the growth, 28% CAGR in AUM, 20% in disbursement, 36% CAGR in PAT. And in spite of all that, it's a small cap company. If you look at the valuation, it's a market cap of 11,000 crore and PE of 24, and price to book, if you look at it, it's now 3.21. So earlier price to book was on higher side. If you look at the price to book, it touched a high of around 10.8 in July 21, and from there the valuation has fallen to now levels of around 3.2. And I think that at current levels the valuations are looking decent. And this final slide gives you a good picture in terms of the liquidity position, where they have got 53,800 million rupee of surplus fund available for business that would help them grow their business. So all in all, I think fundamentally there's no problem, and this correction can be an opportunity. And if you are holding this stock, I don't think there's any need to panic. Okay, in fact, this correction can be utilized. If you understand the business, it can be utilized as an opportunity. So this is it for this video. I hope you got a good idea about the reason why there's a correction in the share price and what you can expect from it. If you have any company that you want me to cover with the con call and do the help you understand the business and the future prospect, let me know in the comment. I'll see you next video. Till then, take care.